public face of IndexUniverse LLC. We are the leading authority on news and data about ETFs, and we're also the company behind Inside ETFs, the world's biggest ETF conference. Before we get started, I'd like everyone to know that they can ask questions at any time during the webinar in the window at the lower right of your screens, and that the presentation will be available to all of you 24 to 48 hours following today's webinar. I'm really happy to welcome my guests this afternoon. Joining me are Larry Adam and Martin Kremenstein from Deutsche Asset and Wealth Management. Larry is a managing director and chief investment strategy in the United States for the wealth management arm of Deutsche Asset and Wealth Management. He sits on the U.S. Investment Committee, the management team responsible for investment strategy and asset allocation for U.S. discretionary client portfolios. He is also a member of Deutsche Bank's Global Investment Committee that formalizes and establishes the Global House View. And as I said, I'm also joined by Martin Kremenstein. Martin is a managing director with responsibility for managing the passive business in the Americas. Martin oversees both the PowerShares DB commodity and currency fund platform, and crucially to today's webinar, the newer DBX trackers lineup, which includes the first suite of currency hedged equity ETFs available to U.S. investors. Now, as I've mentioned, Deutsche Asset and Wealth Management has a number of currency-related ETFs on the U.S. market today, and ones that are particularly important and relevant in today's marketplace are the DBX trackers, currency hedge equity ETFs that I just mentioned, and they also consist of regional and country-specific ETFs tracking MSCI indices. Of particular importance in that family of ETFs is the DBX Trackers MSCI Japan Equity Hedge ETF. It trades on the New York Stock Exchange under the symbol DBJP. It has about 56 million in assets, and additionally, we are also going to be looking closely at the DBX Trackers MSCI EAFE Hedged Equity ETF. That one also trades on NYSE's ARCA under the symbol DBEF. It has a little more than $35 million. So we have a lot to talk about today, particularly with currencies in such sharp focus given the influence of central banks over the macroeconomy since the market crash of 2008 and 2009. Additionally, recent dollar strength against currencies such as the yen and the euro beg the question as to whether a new era of dollar strength may soon be upon us. In particular, Japan and its aim to weaken its yen has emerged in the past several months as a major theme in global investment markets, and Deutsche's DBJP looms large as perhaps the very best way to play this exciting turn of events that has put Japanese equities back on investors' radar screens in a big way. Additionally, the prospect of continued euro weakening puts the other DBX Trackers product that I mentioned earlier, DBEF, in sharp focus as well. Now, with these broad brushstrokes and specific ETFs in mind, it's my pleasure to introduce to you Larry Adam, U.S. Chief Investment Strategies for the Wealth Management arm of Deutsche Asset and Wealth Management. Larry, it's all up to you.
Great. Thank you, Ali, and good afternoon, everyone, and thank you for joining us today. For my part of the presentation, I'm really going to address two different topics. The first thing I'm going to do is give you the 4 reasons why we remain constructive on global equities, and then the second thing I wanted to do is to give you 4 reasons why we think that the dollar will continue to strengthen. Now, on this page that you have in front of you, this really just summarizes the 4 reasons why we remain constructive on global equities. And the first point is that you still continue to see aggressive synchronized monetary policy, which is really the don't fight the Fed mantra, but in many ways you could probably extend that to don't fight global central banks that continue to act in this semi-synchronized fashion. And if you just look over the last week, we've seen the Bank of Australia and the Bank of Korea similarly cut rates during the last couple of days. Number 2, accelerating global economic growth, which we believe will occur during the second half of this year, and which is really paramount to driving top-line growth, which year-to-date has been rather tepid. Number 3, attractive absolute valuations. And this is from a PE perspective. We'll go over some charts, but global equities are approaching fair value, but they're not expensive. I think when you include dividends, et cetera, I think they still offer decent valuations. And then the other thing we're going to do is this easier path to a 3% long-term return. And what we're going to do there is extend the investment horizon now 5 years, and we'll analyze the dynamics of earning just a 3% return for both equities and bonds over a 5-year period on an annualized basis, and really demonstrate why the path is much easier for equities. Now, the first page goes over the aggressive synchronized monetary policy, and I think that that will continue globally. And what we're going to do really is focus on the Fed here. And the reason I think the Fed will continue to be aggressive and expand their balance sheet to $4 trillion by this time next year is because I think they're very pleased with the results. And the reason I say that is because when I look at the table or the chart on the left-hand side, that's really been the impact on consumers. So not only have consumers benefited from the fact that the equity markets have rallied, not only have they benefited from the fact that mortgage rates have gone to record lows and have supported the housing market, but when you look at the household debt service ratio, which is the amount of money that we all spend to float our debt, you can see there by the blue line, it is at decade lows. So that helps reduce the burden of debt that we actually have to carry. If you look at the chart on the right-hand side, that's really been the positive impact that's occurred within corporate America. What that line shows you is that since 2008, corporations have actually taken the advantage of low rates to extend the maturity of the debt on their balance sheet. In fact, they've extended it from about 5.5 years all the way out to about 7 years to lock in these lower rates. What's even more important is that if you go back to 2008 and compare it to today's levels, you'd see that corporate America actually has 15% more debt on their balance sheet, but the actual service payments that they have to float is actually 48% less. So they have more debt, but the servicing of that debt is actually cost them less. And that's why you see corporate America's balance sheet getting healthier, and you're seeing it positively impact earnings as the debt is actually a lower burden. If you look at it from a government perspective, you'd see that from 1996, the blue line on the left-hand chart, government debt has tripled. Yet if you look at the red line, which is the interest payments that we pay, they've actually gone down over that time period. So we have tripled the debt, but we actually pay less to float all the debt here in the United States. And then the little dirty secret on the right-hand side would show you that over the next 5 years, the U.S. government actually has to refinance 66% of its total outstanding debt. So really the government is doing all of us a favor, because if in fact interest rates were to go higher, that would eat into the discretionary budget that the government has, and it would actually lead to a much more difficult discussion surrounding taxes and spending cuts down in Washington. Now, with the success of the Fed, what I think that this has done globally is it's become the blueprint to other central banks. And that's why you've continued to see the Bank of Japan be even more aggressive than the Fed. That's why the Bank of England has been as aggressive as the Fed. And that's why I think by the end of this year, you will ultimately see the ECB become aggressive as well. Now, the second reason we like global equities is because they should benefit from accelerating global economic growth. On the left-hand side, that is our world GDP forecast. And you can see we're accelerating this year up to 3.2% from last year's 2.9% rate. And as we go into 2014, we actually think you'll see a bigger jump in global economic growth, and that'll be up to 4%. This growth is being driven by already record low rates, which you see on the right-hand chart, in both the developed markets, and also you're starting to see those rates come down in the top two lines, which is the emerging markets. And if, in fact, inflationary pressures continue to recede, I think you'll see much more aggressive actions taken by the emerging market central banks as well. The important point I wanted to make here is that when you have higher growth, you get higher earnings. That probably leads to positive fund flows to this asset class, and it ultimately leads to a revaluation of PEs. And when you look at the revaluation or PE expansion component, a big part of this will actually encompass the returns going forward. Because when you look at the chart on the left-hand side, what you'd see is that on a trailing PE basis, the MSCI All Country World is trading at the lower part of the range that it has been in since the late 80s. So from a valuation perspective, in aggregate, equities are still inexpensive, and they're just approaching fair value, which would be the midpoint of that range. Now, on the right-hand chart, that if you look at valuations on a regional basis, what you'd see is that from a historical context, the S&P 500 is trading at a 15% discount, but other regions around the world, the emerging markets, Japan, Europe, they're all trading at a steeper discount and may ultimately offer some longer-term value within the global equity space. Now, the final reason we like equities longer term is that it appears to me that the path to an annualized 3% return is actually easier for equities than bonds. So what we've done for comparison purposes is we've given you the return path to a 3% return in the top table there, which is for the bond market, which is represented by the 10-year Treasury bond. And then in the bottom chart, it's for equities, which we represent through the S&P 500. So what you'd see in the top chart is that to get a 3% annualized return over the next 5 years, you would have to see the 10-year Treasury rate, which was at 1.7% when we did this analysis. It would have to fall to 1.1% and stay there over the next 5 years. So that's the backdrop to that. If you look at the equity, and we use the S&P 500 at the bottom, you would only have to see the S&P 500 rally 60 points, which from the end of April was going to 1657. It would only have to rally 60 points to get that 3% return on average over the next 5 years. The reason for that is that a large part of that 3% would be achieved through the dividend income generated by equities, and that amounts to 2.2%. So the reality is that you would only need about a 0.8% return from your equities from a price appreciation perspective to get to that 3% return. The reason I draw this analogy for you is because when I look at that 3% bar, I actually think that there is downside risk to bonds because I don't think rates will stay down to 1.1%, and I think ultimately over time they will grind higher. But I do think that there is upside risk to that 1657 number that we have here for the equity markets. So again, I think that there's upside to that equity returns longer term. The other important point I wanted to draw to your attention here is that when you look at dividends, which is a big component of that equity return, is that if you look at the top right chart, you'd see that year to date, 152 companies have raised their dividends, only 6 have cut. So clearly the trend continues to be for CEOs and CFOs to increase their dividends and pay more out to investors in a shareholder-friendly fashion. Now, looking at this example on a global basis, I would just point you to the bottom right chart. And what you'd see is that if you did this analysis on a global basis, if you look everywhere for the first 5 bars from the Euro Stoxx 50 all the way over to the Hang Seng, you wouldn't even need any price appreciation to get to that 3% number over a 5-year period. And the reason for that is that when you look at those indices, they all have dividend yields already in excess of 3%. So on a relative basis, equities remain attractive to bonds. Now, in the near term, I do expect a shallow pullback in the equity markets. The primary reason for that is that pullbacks happen. If you look at the top left chart, what you'd see is that on average, we get about 4 pullbacks a year, and we define pullbacks of a 5% correction. You get at least 4 per year. We haven't had one year to date, and we haven't had one since last November. So from a timing perspective, I think we need a pullback to at least digest some of the significant gains that we've had since November, which now have approached 20%. The right-hand chart at the top shows you over the last 4 years, the S&P 500 has followed a familiar path in the sense that it has rallied from January into the end of April. But then as the calendar has turned from April into May, you've seen some weakness. My expectations are that you could see some weakness here over the next month or so because I do think that some of the data will come in softer than what is expected. And then also during this time period, historically is when you see lower fund flows in aggregate into the equity space. So for those reasons, I think you could see a modest pullback, again, which I think should be viewed as a buying opportunity longer term for equities. The bottom chart that we have there just shows you equity performance on a longer term basis back to 1928 in the blue bar. Gray goes back to 1980, and what you see there in the middle, May through September, it has historically been the weaker time period for the S&P 500. The returns haven't been as robust, but again, they're not awful. They're still positive, but they haven't been as robust. The more robust returns tend to happen at the bookends of the year. At the beginning of the year, January through April, and then at the end of the year, October through December. Now, while I continue to favor U.S. equities, we do continue to advise diversifying equity portfolios globally. And the one factor that is likely to improve the backdrop of international equities over the near term is going to be this strengthening of the dollar. And the reason I say that is because if you look at the top two charts, it really shows you how the dynamics have changed as the economy has become more globalized and corporations have become more globalized. And the reason I say that is if you look at the left-hand chart at the top, it would show you that from 1990 to 1999, there was actually a positive relationship between the direction of the dollar and the direction of the S&P 500. So as the dollar rallied, the S&P 500 tended to go higher. Part of that was because the U.S. was the place to be as the tech revolution occurred during the 1990s. It's also because there wasn't as much growth, if you will, in foreign sales for corporate America. But that dynamic has changed, and that's being reflected on the top right chart from 2000 to 2012. And what you see now is that there is a negative correlation between the dollar and the S&P 500. And that's really highlighted in the bottom left quadrant in that chart. And the reason for that is that as the dollar strengthens, our goods become less competitive, and it actually hampers multinational companies in the U.S. from selling globally. And what you see there on the left-hand bottom chart is that 40% of the sales of corporate America now emanate overseas. So a weaker dollar has historically helped, but now conversely, a stronger dollar will now hamper sales growth while simultaneously helping international companies from their earnings perspective. So in many ways, the stronger dollar could help other regions around the world. And I think you're seeing that take place right now with Japan, because as the yen has weakened, you've seen positive earnings revisions start to positively impact those earnings and also their performance as the Nikkei has rallied substantially year to date. Now, can emerging markets emerge from subpar performance? On the top left chart, what you see there is that year to date, the U.S. has significantly outperformed the emerging markets by almost 1,400 basis points. I will tell you that investing in emerging markets is probably one of our biggest non-consensus calls, because when you look at the GDP forecast coming from China, we do not think that China will grow by 8% between now and next year. We don't think it'll be 8.5%. If you look at that chart, we think that by this time next year, China's GDP will be approaching 9%. And again, with higher growth comes better earnings, and it probably leads to a revaluation or higher PEs. And if you look at the bottom chart right there, what you would see is that on a historical basis, emerging markets are trading at very attractive valuations. So as we progress throughout this year, I think you will see the emerging markets narrow that underperformance gap and actually move higher. Now, I've made numerous references to our expectation that the dollar is at an inflection point and poised to strengthen. And the four reasons we believe that the dollar will strengthen include, number one, we see secular, not cyclical trends in the dollar. So what you'll see is that from a historical perspective, the dollar doesn't tend to be very volatile from a month-to-month, year-over-year basis. It tends to follow these well-defined, longer-term secular trends. Second reason, superior U.S. economic growth prospects, particularly versus the rest of the developed world, should support the dollar. Number 3, better economic growth tends to mean relatively less aggressive monetary policy. So we think that the Fed will probably start to lighten up on their easing policy sooner than some of the other developed market central banks. And then number 4, because of the better growth prospects and because of more economic stability, you should see positive fund flows move into the U.S., and that should remain a support as well for the dollar. Now, turning to this first point, we believe the dollar moves in what we call secular, not cyclical trends. And when you look at the chart, you'd see that over the last 40 years, basically the dollar has seen 5 major cycles, both upward and downward. And on average, they last about 8 years. And we just came off of a 9-year period where the dollar basically declined 40%. But when you talk to the FX specialist here at at Deutsche Bank, they think that we are set for a multi-year uptrend for the dollar. And if anything, they believe that there is risk to underestimating the ultimate magnitude of this dollar revival. Now, when you talk about relatively less aggressive monetary policy, you have to look around the world. And basically what you're seeing is that policymakers in other regions like Japan, and I believe eventually in Europe, will probably show their willingness to weaken their currencies against the dollar. And remember that when you talk about regions like Japan and then Europe, they're export-driven economies where a weakening currency would bolster their growth. So it seems to fit that should be and could be part of their strategy. Now, when you look at that top left chart, that shows you the progression of Fed balance sheet expansion. We think that it moves to about $4 trillion by this time next year. But if you look at the bottom chart, that's of the Bank of Japan, and we think that those holdings will double over the next 2 years. So now to put them into a relative basis, what we've done on the right-hand side is basically index balance sheets as of today to 100. And what you'd see is that going from this point forward, the Bank of Japan will be the most aggressive from a QE perspective. The other thing that you'll note is that if you look at the light dashed gray line, what you would see is that is the ECB. And while the ECB may contract its balance sheet in the near term, we think ultimately they will do a turnaround and actually start to expand their balance sheet, and it will be at a faster clip than what the Federal Reserve is doing. And that as well will lead to a weakening euro. Now, what's also interesting about this strategy that these countries could pursue is that more recently, when you looked at what the Bank of Japan was doing, and obviously it's been very aggressive and very deliberate, there was a lot of talk that at the most recent G20 meeting, there would be a lot of tension around this strategy. But just the opposite happened. There was very little tension around the Japanese strategy, and we believe that probably gives ground cover for Japan to continue and for other nations to potentially start to explore these type of non-traditional policies. Now, the other fundamental that continues to support the dollar is superior U.S. economic growth prospects, particularly versus the rest of the developed markets. If you look at the chart on the right-hand side, if you look at the blue bars, which is the U.S. projections that we have here at Deutsche Bank, what you'd see is that not only is the U.S. positive, but it's the only one that's continuing to be positive and accelerating. And that acceleration should widen the gap, if you will, of GDP growth versus the rest of the world. If you look at it differently on the chart on the right-hand side, if you index growth back to 1992, what you would see is that U.S. growth has had a much faster growth trajectory, which is the green line, and it's also exhibited a lot more stability. You haven't seen as much as the fluctuations that you've seen in other parts of the world. And then you've also seen the resilience of the U.S. economy, because not only have we recovered our growth since the Great Recession, but we've continued to move higher and have a record GDP growth here in the U.S., where many of the other parts of Europe, for example, have not been able to do that. Now, because of better growth prospects, our expectation that inflation will remain contained, there's relatively higher interest rates that may occur, and better demographics here in the U.S., that will likely cause capital flows to come to the United States. And when you have capital flows, that tends to support the currency, and again, that will likely lead to a strengthening dollar. Now, it's important to convey that, from our opinion, hedging does matter going forward. And the reason I say that is because over the last 9 years, investors in many ways, when they've invested overseas, have been spoiled because the weakness in the dollar has actually benefited those investments overseas. However, as the dollar starts to rally, the opposite part of that story is going to unfold, and it will actually be a detriment to investing overseas. And just to give you a little taste of how that has happened so far year to date, if you look at the chart on the left-hand side, what you would see is that Japan, through April 25th, was actually up 38%. But as an investor here in the U.S., if you did not hedge, you would have only been up about 20%. So you would have given up 18% of your return because the yen weakened. Now, similarly, if you look at the UK, just as in another example, now the magnitude hasn't been as great from the currency. It's been 5%. But if you look at that bar, it's been about half of the return you would have lost because of the fact that you didn't hedge the currency and the dollar ultimately rallied versus the pound. Now, if you look at our forecast going forward, which is on the right-hand side, as of April 25th, which you would have seen, our 12-month forecast for the Japanese yen was 105. The euro, it was 122. For the pound, it was 146. From those levels of April 25th, what I would tell you is that they could have had a significant impact on your performance investing in those markets overseas. Because what you would have seen is that you would have lost somewhere between 6 to 7.5% if you did not hedge your currency versus what you could have gotten if you did hedge your currency. So that is why I believe it is so important to consider hedging some of your international exposure. And to discuss more about hedging and how these ETFs are constructed, I'm going to actually turn it over to Martin.
Thank you very much, Larry. So, back in 2011, we worked with MSCI to bring out currency hedged versions of some of their international benchmark equity indices. Back then, we were working with them. Our currency forecasters had seen kind of the long-term slide in the dollar, and we're looking to put together products that would help investors in a scenario where the dollar would start to appreciate versus other currencies. And the products we came out with were the 4 products that we're going to talk about. The first one is the DBEF is the ticker. It's the MSCI index with the currency hedged out. And you can see from this slide here, on a returns basis, by hedging out the currency, over 6 months you've outperformed by maybe 5%. Same thing over 1 year. I think what's more interesting, though, for the long term and the idea of using currency hedge products as an allocation is the volatility reduction that you get. So if you think about the EAFE basket, by hedging that out, you've reduced your volatility by around 23%. And you think about what those currencies are. So EAFE itself is about 30% euro, about 20% British pound, 10% Swiss franc, and then 20% Japanese yen, and then the other 20% is mostly in Asia-Pacific currencies. But you've got a full 80% of that basket, which most forecasters have predicted to decline over the next couple of years. The other thing about it, in returning to the volatility component, during a big sell-off, there tends to be a flight to quality, and the flight to quality currencies tend to be the US dollar, the Japanese yen, Swiss franc. So when you look at the EAFE basket, most of that basket is going to sell off versus the US dollar, and the only ones that are going to appreciate, or potentially could appreciate, would be the Japanese yen and the Swiss franc. So if you hedge out the currency during that sell-off, you're actually going to reduce the volatility and reduce the downside risk that you've got in your portfolio. And the question is, why invest in the MSCI EAFE index? Just from an equity perspective, the dividend yields are 340 basis points versus 210 for the S&P 500, and the price to earnings ratio is significantly better as well. So from an equity perspective, you've got a diversified basket of equities that currently has better fundamentals, so to speak, than the S&P 500 would. However, as I said before, you've got 80% of that basket is denominated in currencies that most forecasters have a strong conviction for declines over the next couple of years. So in order to really fully benefit from that fundamental story, investors need to look at using currency hedge products to get that exposure. And the next product we're going to talk about is the emerging markets one. DBEM is the ticker, and it's a very similar story to EAFE. In terms of returns, emerging market currencies haven't declined as much as developed market currencies have against the US dollar, but I think in a secular US dollar bull market, you would expect to see general declines coming from those currencies over time. But again, the volatility story is probably the more compelling aspect here. You've reduced the volatility by 25% since the inception of the index. And so again, when you're looking at improving the quality of the returns in your portfolio and improving the actual volatility and Sharpe ratios that you have, using a hedge product alongside or as a replacement for an unhedged product can have a very, very beneficial effect there. So again, the story around emerging markets, it's giving you exposure to the big growth engine of the world. They're expected to grow 5.5% and 5.9% in 2013, 2014, respectively. And DBEM offers direct exposure to those equities whilst removing the currency exposure and the currency risk that you have from them. The PE ratios of the MSCI EM index is vastly better than the S&P 500, so you're generally getting a better fundamental story from that. I think the big story over the last 18 months or last 1 year or so has been Japan. As Larry stated before, investors in Japan over the 1 year, picked up an extra 15% or so by hedging out the currency exposure. And I think a lot of people are talking about the idea of Arbonomics as the Japanese government looks to devalue the yen in order to bring in inflation. They've had 20, 30 years of deflation now, and they're looking to fundamentally kickstart the economy by targeting a 2% inflation target. And they're going to do that with a variety of quantitative QE measures. And so I'm actually, even before the call started, the Japanese yen just blew through 100 versus the dollar for the first time in a while, and it's continued to decline since then. I think 100 was a big barrier level. But the 6-month return of a hedged dollar position was 41%. The 6-month return of an unhedged position to the end of last quarter was 18%. So there's a 23% benefit from having hedged out the currency exposure. And a lot of people see this devaluation going further over the next couple of years, and it's going to have a very, very beneficial effect on the Nikkei and the Japanese equity market in general. But if you haven't hedged out your currency exposure, you run the risk of missing out on a lot of that gain. As I said before, with the exception of Japan, most currencies, when you hedge them out, it's going to reduce volatility. Here, the effect on volatility is broadly flat because, as stated before, the Japanese yen is a flight to quality currency during big market sell-offs. So, hedging out the exposure doesn't do a huge amount for the volatility. However, in terms of topicality of the trade, Japan with a currency hedge is definitely a big story right now for investors. So this is just kind of the story why Japan. The BOJ has targeted this 2% inflation target. Japan is an export-oriented economy and does stand to grow, benefit from a weakening yen and a pickup in global growth. And Japanese equities do trade at a discount to their historical value. I think an interesting thing about Japan is that because it is such an export-focused economy, you can expect that as the yen declines, it won't just be exporters that benefit from the devaluation of the yen, because if the exporters are doing better, then the companies that they buy from will do better. The companies that rely on domestic consumption will do better because more people are working and earning more. And in particular, financial institutions should outperform. And in fact, financial institutions, I think, have been the top performing sector year to date. And so, although the kind of the export focus of Japan does lend itself well to benefit from a devalued yen, which is one of the reasons why the government's looking to do that. It's not just an export story. It's about every single equity in Japan, partly just being revalued because the yen's decline, but also partly benefiting from general, increased growth and exports from those companies. The final one we're going to talk about is the MSCI Brazil Hedged Equity Fund. Brazil is a great story long term. When you look at what Brazil has, it basically has everything that the rest of the world wants. It has energy, it has food, it has some metals, and it has some food that is energy as well. Brazil is a fantastic story. However, the Brazilian government has been trying for quite some time to devalue the Brazilian real. If you think about getting exposure to Brazil, one of the things you are risking is the effect if the government does choose to devalue the real. I think in September 2011, the real devalued by about 15% just in that 1 month, just showing kind of the volatility that can come from the currency component of that exposure. You can see hedging out Brazilian real from your equity position has reduced your volatility by 26%. So again, you're improving the quality of your returns. Over the 1 year period, you've picked up an extra 4% by hedging out the exposure. I was reading a Bloomberg news story, I think last week, and it was stating that a lot of big U.S. exporters to Brazil, in particular I think some of the car companies, have started to hedge out their exposure to income streams denominated in Brazilian real as they start to worry about a possible depreciation of that currency. And, just looking at the fundamentals behind Brazil, why Brazil? The growth numbers are pretty good, 3.5%, 4%. The stimulus that was enacted is spurring investment and boosting the economy. And then, the spend and infrastructure development that's going to come from the 2014 World Cup and the 2016 Summer Olympics are also going to boost the economy and boost productivity. So I think Brazil has a good story, and I think, again, what investors need to worry about is really that second part of that trade, what is going to happen to their position from the currency exposure that's generated by it. This is just a final kind of display sheet about the products. You've got the DB MSCI EAFE product, ticker DBEF, net expense ratio of 35 basis points, the MSCI Emerging Markets product, DBEM, net expense ratio of 65 basis points, the Brazil Fund, DBBR, 60 basis points expense ratio, and then DBJP, our Japan Fund, with an expense ratio of 50 basis points. And that's a full suite of products, and with that I'm going to pass it back over to Ollie, who's going to open up for questions.
Thank you very much, both Larry and Martin. Very interesting, informative presentations. We'll go from, like you guys, from the macro to the micro. Let me ask you first, Martin. I couldn't help but to notice, being in the traffic, that DBJP, the Japan currency hedged ETF that you have on the market, is in fact outperforming its competitor, DXJ from Wisdom Tree. And that begs the question of what is going on there. Obviously, not all beta is created equal. You began to touch on it a little bit in terms of the broader exposure that the MSCI index affords. But I'm wondering if you might roll up your sleeves and get a little more granular in explaining what's going on there. What's to recommend that makes DBJP, for one, returned more so far this year, for example, but also why is it a better choice for investors?
Sure. And far be it from me to criticize someone else's product. I think one of the things that really recommends DBJP is that it does give much broader exposure to the Japanese economy by not having an exporter bias to it. I think where you end up underweighting massively when you concentrate on exporters is you underweight in financials. When we did a kind of a breakdown of where the outperformance was coming from, the outperformance has been about 5% year to date, and a full, I think, 3.6 or 3.7% came from financials, because DXJ would be considered underweight financials with maybe a 7% exposure. DBJP has around a 20.5 to 21% exposure to financials. And if you think about what happened here when we entered into our QE1, QE2, QE3, who really benefited from it? It was financials. And so Japan is entering a quantitative easing process, and so you can expect financials to benefit. And recent news reports are reporting out out of Japan that year-to-date IPOs are at a record, year-to-date brokerage revenues are running at record run rates. Then you take it further away from equity markets and you look at, say, real estate. If real estate does increase in value, finally after 30 years of virtually straight declines, then that's also going to help out financial institutions because they have a lot of capital tied up on loans secured on real estate. So I think we've seen a lot of the outperformance come from financials, and I think as the yen continues to decline, you should probably see more of that, because financials, I think, are ideally placed to benefit from this kind of process. So by having a market weight to financials, DBJP has outperformed, and I think you can probably expect that kind of outperformance to continue.
Fair enough. You talked, Martin, about the continuation of this yen weakening trend, and that gives rise to a much more macro question for you, Larry. You had touched on this during your presentation. I believe your chart, you looked at the balance sheet of the Bank of Japan, saying that the BOJ's balance sheet would probably double in the next 2 years. That was, I have that correct, right?
Yes.
Okay. So the question is, how deep is this yen weakening trend? You talk about 2 additional years of it, I presume, and you also pointed out, and I think that was an incisive observation, that there seems to be fairly consistent acceptance globally among policy leaders. They're not going to stand in the way of this thing, and so the train has left the station, and where's it going to? How much longer?
So I think that there's still plenty of room for the yen to depreciate. In fact, just let me give you a little flavor of what our FX specialists have for their forecast. So when you go out to 2014, they have the yen at 110, and then when you go out to 2015, you're talking about a 120. And the reason I point that out is because for the longest time, and I think this has been across the street, that everybody knew that the yen was artificially being propped up. For some reason, everyone thought that it should have been closer to 100, if not higher than that. But I think what's important that I wanted to convey is that the speed at which this has happened. I mean, think about this: we were at a yen of about below 80 back in October of last year. So basically, in 6 months, you've seen a dramatic normalization of the yen, and I think that that's one of the reasons why there hasn't been as much of talked about it, because I think that part of this is part of the normalization of what where the yen should be. And again, when you look at a lot of the sophisticated models that our FX guys have, purchasing power parity type of model, et cetera, the fair value is probably closer to that 120, 125 level longer term. So that's why we think that if anything, we're underestimating, at least the street is underestimating the eventual depreciation of the yen going forward.
Now, go ahead. I'm sorry.
Sorry, I just want to add one thing to that. I was just pulling up a chart of the Japanese yen versus the dollar going back to 2001, and I think if people think that 120 on the yen is kind of a crazy number, we were through that level as recently as 2007. The middle of 2007, the yen was pricing at around 123, 124. And if you go back to 2002, the yen was up at 134.7 or down at 134.71. So you don't have to go back too far to find prices for Japanese yen that would augur a massive decline from where we are now. So it's not. I mean, although the recent decline looks very, very steep, it isn't without precedent, and we're still a long way off from kind of recent historical lows for the Japanese yen.
Right. Now, one strain of questions that we're seeing coming in here is some of the more problematic aspects of this whole currency phenomenon, and I'm making allusion to what some people call currency wars. Oftentimes it seems perhaps a touch emotionally reactive. There's not a lot of specificity attached to that, but I'm wondering if perhaps Larry first, you could touch on what if this gets out of hand. And I'm thinking about what we saw. Australia's central bank cut rates. I think Korea has cut rates. There's a sign of actual potential tension emerging between China and Japan in connection with this trend. What of this currency war concept? What are the dangers to investors, or is this all good to the extent that there are now vehicles out there, such as the ones that you guys are describing here, that would protect investors from anything sort of untoward unfolding as it relates to the currency piece of an investment profile of returns?
Well, again, when it comes to currency wars, I agree that the products such as the one that Martin are talking about are very good ways to hedge this out. But you have to remember that when you talk about currencies, obviously there's winners and there's losers. And I have to tell you, probably one of the biggest factors that people underappreciate on an economy is the change in the dollar. So we have this analysis that we do, for example, a 10% change, a 10% appreciation of the dollar over the course of a 3-year period will probably subtract about 2.5 percentage points from GDP in aggregate, okay, cumulatively. So you're talking about a little over 0.7, 0.8 per year. That's a pretty dramatic reduction in growth in just a very small period of time. So what I think then ultimately happens is it then becomes a cycle, and that the U.S., if that were to occur, then the U.S. starts to show some signs of weakness, and then they start to become a lot more aggressive from a monetary policy perspective, et cetera, and then that tends to lead to some weakness in the dollar longer term. So it does tend to ebb and flow, and that's why these products should be, you can use them more tactically in many regards to hedge the portfolio when you do see these things getting ready to unfold.
Martin, why don't you take that up, what Larry just touched on, because that's another series of questions that are coming in here. How should you use these? Clearly, in the case of Japan and possibly in the case of Europe, which we'll get to in a moment, it makes a whole lot of sense in the here and now. But clearly, how do you take off this kind of a strategy or integrate it into more of a long-term view? How should investors and advisors really kind of conceptualize what they're looking at in their toolbox?
I think that's a very good question, Ollie, and I think really to kind of answer that, you need to go back to before these products came out, when investors, if they wanted to invest in international equities, they had no choice. They had to, or at least the smaller investor had no choice. They had to take the currency exposure whether they wanted to or not. And some people would say, well, I buy international equities for the currency exposure. Well, that's great if the currency is undervalued, but if it's overvalued, then you're buying a declining asset. And so we looked at these products, and there are certain ones like single country exposures we think give a very targeted exposure to a kind of a high conviction trade. For the basket products like EAFE and EM, the way we kind of see it is that when investors are taking a position in equities, they normally have a good view on the equities. They don't normally have such a strong view on the currency. Obviously, I'm kind of generalizing it, but for the most part, investors look at equity valuations, and they look to invest based on that. So if that's their view, then without a strong conviction on the currencies, they should start with a 50-50 hedged and unhedged position. That's your currency neutral position. Right, and then if you develop, or as you develop strong conviction on the currency aspect of it, you would then move your ratios to reflect that conviction. So, for example, you start at 50-50, but you believe the dollar is going to just tank and going to decline over the next few years. Well, then you move to immediately 100% in unhedged products. However, if you start again at 50-50, no view, but your conviction is now that the dollar is going to strengthen, well, then you want to move 100% into hedged products. If, however, you have a general view that the dollar will probably appreciate, maybe you have 70% hedged, 30% unhedged. And so that's one of the main ways that we think we're going to, and we have started to see investors use them in their portfolios, is essentially to take control of the returns and the risk that are coming from their currencies. Prior to that, investors had essentially been very passively taking currency exposure and currency risk. Now they are able to use passive products in order to take an active view on the currency exposure, as they do with the equity exposure.
Very well. Now, as long as you have the floor there, Martin, one of the things I'm slightly puzzled by is the investment thesis for DBEF, the EAFE ETF that you've been talking about here. Clearly, about a year ago, before the ECB sort of indicated it was going to be all in the way that perhaps the Fed has or the Bank of England, it looked much more perspective, at least the way at first blush, the way I look at it. You know, the Eurozone ripping apart at the seams, et cetera, et cetera. There seems to be a bottom in, and no one's predicting a massive bull market in Europe, but the prospects for a weakening Europe look a little bit dimmer, shall we say, than they did 12 months ago. And I'm wondering if you might walk us through a little bit how this security now, given the current circumstances, still makes a lot of sense.
I think it makes a lot of sense from the perspective that I think the equity story in Europe and just generally in developed markets looks better than it did. But I think the currency aspect, I mean, I think we have a call, and Larry can correct me because he knows better, I think our call on the euro was somewhere down to 122 by the end of this year, and I think it's somewhere between 115 and 120 by the end of 2015. I've seen other forecasters predicting the euro to go to 110. So there is still a fair amount of conviction out there that the euro will continue to decline. And then if you take that further, you look at sterling, the British pound, that correlates very, very highly with the euro. So if the euro declines, you would expect to see the British pound follow the euro down. And then the Swiss franc, where the Swiss National Bank has basically declared a line in the sand at 120 to the euro, they will follow the euro down. They've basically declared that. And so you've then got 60% of the EAFE basket essentially going to track with the euro as it's predicted to decline. You throw in then Japan with its 20%. You've now got 80% of your basket is in currencies that most of the street has kind of a view that will decline over the next 2, 3, 4 years. So that's really where it makes sense. You know, investors need to have international equity exposure for diversification value and just to have exposure to the global economy. However, they don't necessarily have to have exposure to the currencies. And by using this or not using this, they now have the choice of whether or not they want to take that exposure. But I think at the moment, the general it would be sensible to hedge out some or all of that currency exposure that you're getting from that position.
Very well, thank you. Larry, put on your seatbelt. We have a number of macro questions here that are going to test your mettle. One of I like these kind of questions when we come into the currency world, sort of chicken and the egg-ish. One of the general themes of your presentation, Larry, was that there seems to be, indeed, as I suggested in my intro, that there may be an incipient dollar strength trend that's taking shape here around the planet. You know, is it a weak yen or a strong dollar, a weak euro? You know, one could debate it, but in any case, the general theme seems to be strong U.S. dollar growth and strong U.S. equities, and the question really comes down to doesn't a stronger dollar hurt U.S. stocks? You did suggest as much in your presentation, but at what point does that really become problematic and sort of damage the entire macro picture of investing?
Yeah, so again, that's one of the reasons why right now I do favor the U.S., but I think as we transition and progress through this year, I think you'll see me start to become much more favorably disposed to, Europe, because number one, there is no doubt that as with 40% of your revenues coming from overseas, all of a sudden the U.S. companies could have a competitive disadvantage if, in fact, the dollar does continue to strengthen. So, and if you look at historically what happens and what drives equity prices, it's not necessarily the earnings, it's the revisions, plus or minus, right? Better than expected, worse than expected. It's not exactly what that number is. And if the dollar were to continue to strengthen, I would probably look for much more dramatic negative revisions, and that would potentially hamper U.S. equities going forward. And that's why, I think we've learned over the last couple of years about how quickly, monetary policy can change the sentiment in a certain part of the world. Obviously when the Fed introduced QE, it's pretty much at the bottom right here in the U.S. Major game-changing event here for U.S. equities. I couldn't find many investors that wanted to get into Japan last year. Now all of a sudden, that market's up basically almost 40%, right? What was the difference? It was a change in monetary policy. And that's why I think when you look at Europe, I wouldn't necessarily get out of Europe, because I think the next man up is going to be Europe. And you're going to see them, be much more aggressive to help generate growth in that part of the world.
In terms of monetary policy, you're saying?
Yes.
The sort of Bundesbank inflation concern will take a backseat to stimulating growth, you're saying?
I do think so, because I think, you can look at all these different inflation measures, but I still think, particularly here in the U.S., I don't think inflation is a problem at all. And by the way, that stronger dollar will probably keep a lid on inflationary pressures for a longer period of time, and that'll give, again, the Fed will have plenty of ground cover to do what they're doing, because inflation, I think, will remain contained.
Perfect.
I think what's going to happen over in the ECB is that they're going to have to make a decision, right? That yes, as long as inflation is close to what their target is, I think that they have to generate growth because of the way the fiscal austerity is going, et cetera. They're going to have to generate some form of growth over there, and I think the way they do that is by continuing to get rates lower over there and help that transmission mechanism from lower rates actually leading to actual credit creation, because that's really been the missing link over in Europe. If you look at the Bund, right, it's got a lower yield than the Treasury. The problem is that nobody's lending over there.
Right. Now, here's a very specific one. One audience member carted out some very specific numbers you shared with us, Larry. You talked about global growth growing from 3.2% to 4% in 2014, emerging markets growing from 5.5% to 5.9% in 2014, and yet you talk about superior U.S. economic growth prospects should drive the dollar higher. Clarify your expected rate of economic growth relative to those other numbers that this questioner has laid out here.
So in the U.S., so for U.S. we're looking for 2.4% this particular year, and then next year we're talking about north of 3.2%.
Got it.
So versus, I don't have the exact numbers, but versus Europe, which we have it just modestly going positive, I think it's still below 1%, and Japan not all that different from that level as well. So when you look at that, the U.S. will completely have a much higher growth rate than the rest of the world.
Right. We're coming close to the end of our presentation, but I think we have time for one or two more. Martin, this is much more of a mechanistic question, sort of related to what I asked you a moment ago about how to regard these tools in the toolbox. When one questioner has posed the following question: When do you take off a hedge, such as Japan? Is it best just to hedge when the currency range is near the high or low end tail of its long-term historical fluctuation range?
That's a very good question, and I guess you can answer it in two ways. One is, you could either, if you have some kind of trading methodology for currency exposure, whether it's momentum based or mean reversion based, you can use that. I think though, on the whole, you should look at where you expect the Japanese yen to go. You may want to look for a pullback now, because obviously it's just weakened dramatically. But I think, if you don't have a strong conviction, again, going 50-50 will cover you from that perspective. You don't have to take the view. If you don't want to take the view, you just have to understand that not taking a view does not involve just buying an unhedged product. It involves buying the hedged and the unhedged together. In terms of, where do we see the yen going to? I don't know. I mean, we've got a lot of the street predicting somewhere around 120, 125. I think I saw, I can't remember who it was, some very respected currency trader saying it was going to go to 150. There's just no way of knowing, that's predicting the future to a certain extent. But I think putting it on now at 100 is not the riskiest trade you can do. I think most people generally agree that the yen is more likely to go to 110 than it is back down to 90.
Very well. I think we have time for one more, Larry. Let's finish it on Japan, since that's such a powerful story at this point. Any concern from where you sit of a Japan default, that they're getting in over their heads, that this quantitative easing is really the on steroids version is hardly advisable and even dangerous?
Yeah, I think we're going to have to obviously continue to monitor that. Do I think there's a chance of default? No, I don't. I think one of the things similar to what's happening here in the U.S., the funding rate is just so inexpensive for Japan right now that I don't really see that as a major issue going forward. But Japan has had so many other issues, whether it's been demographics, whether it's been sentiment, whether it's been the way they invest over there, primarily into be much more conservative, if you will, focusing on fixed income instead of being much more entrepreneurial, investing in equities, et cetera. So those are probably some of the things that, the question is, can they change that mentality over there to actually start spending and freeing up the domestic economy? And that still has had many false starts, if you will, over the last couple of years. But, hopefully, with the bazooka, and they're using two bazookas over there right now with doing monetary and fiscal policy, so hopefully it'll at least get it onto the right path and at least start to get that inflation at least modestly higher, because as everybody knows, deflation has always been the worst case scenario for an economy. And the reason for that is that deflation means that tomorrow it's going to be cheaper, and if it's going to be cheaper tomorrow, it's going to be cheaper the next day, and that really halts all spending. So if we can at least get some life back into the consumer over there, hopefully everything will work out. And at the very least, just to remind everyone that the economy is not necessarily the equity markets in those respective countries, right? Because when you have an economy that's not as dependent on, that has a difference between versus the companies that have much more export or overseas exposure, they may still continue to flourish despite the economy sitting in a very low growth 1.5% type of GDP range.
Perfect. All right. Well, that uses up all our time. I want to thank you very much, Martin and Larry, and I want to thank the audience for attending and also for some very thoughtful questions. On that note, remember that you can get the presentation within 24 to 48 hours and the slides. On behalf of my guests from Deutsche Asset and Wealth Management and all my colleagues at IndexUniverse, I'm Ollie Ludwig, wishing you all a very pleasant afternoon.